Our next presentation is Access to Finance, which I'm sure is going to create a lot of interest considering the investments that are going in the Middle East. And Mr. Geir Sjurseth, Managing Director and Global Head of Offshore Support, DVB Bank, will be giving us a short presentation on that. Geir has more than 30 years' experience from international finance, shipping, and investment banking, having worked most of his career for institutions in Oslo, Singapore, and London. Among others, he spent 8 years with DNB Nor in Oslo. He was the Chief Operating Officer for the Norwegian Singapore ship owner Westphal Larsen Masterbank for 6 years and joined DVB Bank in 2000, building up the bank's global shipping advisory and MA business. From 2007, he was appointed Managing Director and Head of the bank's newly established Offshore Support Group. Please welcome Mr. Geir Sjurseth.
Good morning, everybody. I'm very happy to be here. Thanks to Seatrade for, again, a kind invitation to join this year's events. Now, if you read the headlines, I put in deliberately what I call unsustainable disconnects. We have heard this morning that, yes, we are living in an energy-related world. We talk about offshore. There's a lot of optimism. The outlook is good. Market drivers are there. Oil price is fine. E&P spending is even better. So why worry? Well, coming from a bank's point of view, there are certainly, I would say, a lot of issues and disconnects actually taking place as we speak. We are, in a way, standing at a lot of crossroads, which tells me that it is not as nice as we could expect. I will try to explain what these disconnects are. I will try to explain how I look at the offshore market, and in this context today, the OSV market, not the drilling market. But the impacts on the bank's position in the market will also impact the drilling market, clearly. Now, if we just a quick glance on DVB Bank, even this year, we are lending out $3.5 billion in new business on shipping and offshore. We did the same last year, the same year before. But if we go 4 or 5 years back in time, we lent out 7, 8, 9 billion a year. So clearly the whole equation has changed. And don't forget that we are all components in that equation. So even though offshore is doing fine, I'm just not allowed to ring fence myself in the bank and say, I'm very happy that I'm dealing with offshore. I don't want to talk to you guys doing shipping. Clearly, we are part of a bigger equation, and that is currently impacting us negatively. Now, this $3.5 billion a year is pretty much not more than clients are paying back to us, and we are very happy that clients do pay us back, which means that we have a growth of maybe 2–3% a year in this scenario. Then look at all the other banks basically doing nothing. Their balance sheets are shrinking faster than you think, and that's why there's basically much less capacity in the ship or in offshore lending market as we speak. Now, this is my little universe. I think it's tremendously large. And you go from the left to the right, from more conventional OSVs to more complex subsea and seismic vessels. And clearly my topic today is to address the financing of the OSVs, and predominantly in the Middle East market. Now, unsustainable disconnects. I have 2 drivers for you to think of. Let's take the first one. You know, something is going very down at the moment, while offshore is doing the opposite. Whether you talk about the dry bulk market, the container market, the tanker market, or the chemical tanker market in this respect, they're all facing immense problems. And it's not going away. It has been problems now for the last 3–4 years. And why are we still having problems? Well, because the banks have been dancing with their clients into the next morning, into the next year, to see whether time could bail us out. That dancing, ladies and gentlemen, is about to end. And I will show you afterwards, well, you know what's happening in the big world, but we come to a point where loan loss provisions and losses with banks are just mounting to levels we haven't seen for, the last 10, 20, even 30 years. On the right-hand side, we have offshore. How is it possible that offshore can be so disconnected from the rest of the shipping market? I know that the drivers are different. This is energy. Shipping is more commoditized cargo. But in the end, we are all facing the same growth scenarios in this world. So are we now moving ourselves into a more irrational optimism when it comes to offshore? I mean, we came out very nicely during the crisis. I don't have a single problem in my portfolio. I'm extremely lucky. But can this disconnect continue? And for how long can it continue? We have never had more oil in the world than we have today. And this is before the shale oil, gentlemen and ladies, are coming to the market. Nothing tells me that the oil price will not go down. The question is, at what level will it stabilize to still make the offshore market an interesting, profitable market? And that level is around $70, $75 per barrel. And we are coming down. I'm willing to bet that the oil price there's a much bigger chance that it will come down than it will go up in the next 2, 3, 4, 5 years. Now, what's the next disconnect? Now, let's go down to the micro level and look at the OSV market. And yes, the numbers I put on the board here is Bourbon's number from the third quarter this year. They are now having a shallow water marine utilization of an increase from 88 to 91%, which is in what they call the tunnel of where rates will definitely pick up. And this is what we see with many of my clients. Utilization has picked up over the last few years. Thereafter, rates will follow suit. So again, things look fine. On the other hand, though, I see inflated broker values around the world. Your fleets are less worth than what you think they are. That's my observation as we speak. We have a massive yard capacity, in particular in China, which nobody has a clue what will come out of that. They are desperate to get contracts, and they offer you lucrative payment terms to the shipyards. And clearly, when the shipping market is not doing fine, they are focusing everything they have on building more OSVs. Newbuild prices are now softening, coming down. Second-hand values in many of the segments are now finally following suit because there's been a disconnect in these values as well. And stock prices are again hugely lagging. This is the Oslo Oil Services Index, which contains a lot of drilling companies, a lot of the OSV operators, and a lot of oil services companies. If you look at this graph, you say, well, is there a problem? Do we have a problem? Stock prices are back to where they were in 2007-8, before the crisis hit. So what is the problem? Why are you worried? Well, if you start to dig down into these numbers, you will see that the current pricing of listed offshore companies, they're trading at large discounts to net asset values. We talk all the way down to 40% for many companies. No wonder why these companies will not issue more stock to finance their growth, because it will imply dilution, of course, of the existing shareholders. Now, over to, the big news these days. Are these positively related or are they negatively related? If I told you, or if you told me 3 years ago that OSG New York will go into bankruptcy filings, I would say, you must be out of your mind. At that time, the market cap was $3 billion. Now it's $50 million. All these companies used to be very fine companies, among the largest we had in their respective fields. They're all now having severe problems. And banks are ending up as owners of these companies. And do you think banks are in there for the long run? The answer is no. Now, on the finance side, is this good news or is it bad news? It's a whole string of bad news coming out every day from whichever market you want to look at. And I'll tell you, we are far from at the end of the tunnel yet. Paul Slater, you may know him. He's considered by many as a doom and gloom person. I know that he knows a lot about shipping, and one day he will be right. He may not live to see it, but of course, in the end, we will always be right, whatever we say, I think. But it is different this time. We have to admit it is different. in a normal shipping cycle, every 7 years, it's boom and bust because clients order too many vessels. It happens every 7 years. It shouldn't, surprise anyone. But it's different this time, as demand at the same time fell. We've had technological ships or changes to many of the, call it the eco design ships and others. And the banks are having problems at the same time. They just have to shrink their balance sheets. Shipping has become a boo word. Offshore is not. And again, I'm very happy to be here. But I just can't ring fence myself and go in hiding. I mean, if the banks are having problems, they will also issue new directives and new policies, which also potentially may impact my business. Now, financing availability, sure. A lot of people say that the private equity business will fill the gap. They will never fill the gap. It's wishful thinking, and clearly who will fill the gap, because the gap needs to be filled. It is a combination of fewer deals will be done, fewer contracting will have to be done, more cash flow coming from contracts of companies will have to service the debt, and more equity needs to go into the equation. And this, in a nutshell, will actually prove good for the existing offshore operators, because it's much less chance today than 3 years ago that a lot of newcomers are entering the business. Actually, good projects will be financed. This will help maybe consolidating the industry, although I personally don't believe in that either, because offshore owners are so much design, new build focused in their thinking. I mean, I'm covering 100 clients around the world, which is only a fraction of the total universe. We all talk about it, it just doesn't happen. Now, this is my kind of list, what DVB looks at when we consider financing. And there are positives, there are negatives, and there are neutrals. So what does this add up to? Are we, at the end of the day, positive, or are we negative? First of all, offshore finance, there's less capacity available from the banks. There's more capacity available in the bond market, and I like to think that there is more capacity available from the private equity side. But still, the operators, my clients, need to accept to put more equity into every project they do. They can't pull out the presentations they did 3 or 4 years ago and think, nothing has changed, even though we are in a very privileged part of the market. Things have changed. Now, bond market, yes, I think companies should consider the bond markets. A lot of companies have done, primarily in the US and Norway. And unfortunately, the whole situation now with OSG in New York, when there are unsecured bondholders, there are unsecured lenders and secured lenders, we only can wait and see what kind of legal ramification this will have on future bond issues on an unsecured basis. Banks typically lend against security, but the offshore market today is happy to accept unsecured bonds because the interest is there. This is energy, it's positive, the outlook is good, and money is flowing into bonds issued by offshore companies. These are all great names. We all know them well, and the market is now also receptive to unlisted companies, which I didn't believe could be done 12 months ago. But the market has matured a bit more. But clearly, there is a cost of issuing, which is quite significant compared to traditional bank lending. But you get some benefits out of it. I'll mention a few at the bottom right-hand side of the slide. Now, this is DVB's and my outlook for your market come 2013. And I will try to ring fence again, I like the word, the Middle East or local operating companies, what we see for their outlook. Clearly, Caspian is a big part of the Middle East market. We have the Gulf, and of course, a lot of companies here are expanding into West Africa. A few are trading in India. But you will see this, what we're trying to visualize here in terms of sizes of equipment we actually prefer to finance. We are moving towards deep water, deep offshore, it was mentioned earlier. And clearly, the Middle East is not where the growth is in that market. On the other hand, all your charterers in this region are demanding more sophisticated vessels, younger vessels, DP2 vessels, and The companies trading here will need to act and respond to those requests. The old Middle East tonnage will definitely have to be phased out. I'm just afraid that with the Iran business or lack of going on at the moment, a lot of vessels will come back to the Middle East and start to compete for local contracts where charters are still happy with 30 years old vessels. You know, in the offshore market, there's basically there's no steel values to scrap. This is not like a large tanker or a dry bulk carrier. So the economic incentives have to be different for offshore owners to cold stack old vessels. But again, this is my outlook. It may differ from yours. And this is also guiding my ability to finance projects to where are we in these various cells going forward. And this is where we see also the darker, the more green, the better, where the utilization and the rates are the best to achieve. Now, look at the Middle East in particular. There are some particulars again with the Middle East. And again, tenders coming out now are favoring slightly larger vessels, not any longer all the smaller 5150s on the anchor handler side, DP2 clearly. We have, again, it's a large market here, many companies and many small companies, and I ask myself, why is there no consolidation in this market? There has been talks, which there always are, back and forth, but little, if anything, is happening. There are companies and fleets for sale. I guess you all are familiar with that. Little has happened, but I believe that the region will only do better if maybe forces, shareholders, investors start to talk to each other to maybe sort out some of the overcapacity in the older fleet. Now, limited transparency is a problem for banks, not necessarily yourself, but to the extent you want financing. This has changed over the last 5 years in the Middle East. It's less now corporate name-driven lending. It's much more, call it the way actually I believe it should be. Transparency is needed. The final point, Iran, is it's just a no-go. Banks cannot finance any companies that are involved with Iranian trading with their offshore vessels or drill ships for that matter, well, the jackups. And it's not that my ships don't have to trade in Iran, it's just does the client have any other vessel trading there? We have huge problems of actually supporting those clients. This is, I mean, we are being strangled as well as you are, from the UN, from the US, from EU, whoever. This is just a no-go. Clearly, what is the impact or the impact of this? Well, vessels may come back to the Middle East or to UAE to find alternative employment here. I hope that maybe some of these older vessels will be taken out of, trade, full stop, to balance the supply side, but I'm not sure whether that happens or not. This is much more a Dubai Sharia problem, I think, than Abu Dhabi. Abu Dhabi is much more non-Iranian, I think, but going forward, this is extremely difficult, and financing is just not available, and if you're looking for investors, I don't think you will find them either, at least if they have a shred of a Western component in them. So, I think this is what I just commented on. Local banks may have a different strategy than international banks, clearly, but for companies growing fast with the high capex vessels, the needs today are large, and you need more than one bank to do your financing. You need club deals and to work on different parameters. So, to summarize, negatives and positives. At the end, I'm saying that, well, still I'm comfortable, or am I still slightly uncomfortable? Again, if you can look at the offshore market, there's no doubt that the outlook is good. But it's just too many other components in that equation, which today is highly unpredictable. And currently, the banks are not out of the woods yet. There will be less capacity going forward, there's no doubt. And each owner needs to really develop their relations with the banks that trust them and that support them going forward, but at the same time, clearly consider alternatives way of raising financing. That's always a positive. So, thank you very much for your attention.